And welcome back. Thank you so much for joining me in today's video. I have Matt, the mortgage guy, on today's video, as you guys can see. So welcome, Matt. Thank you so much for joining me on the channel.
Yeah, thanks for having me, Jason.
Absolutely. So Matt has been on the channel a few times in the past. And the reason why I'm having him on today's video is that I found some trends that were quite alarming, to say the least. So I gave Matt a phone call yesterday, and we kind of talked about why this may be taking place and maybe some better avenues that people have, or other better options that people who need money, maybe there's some better options regarding doing instead of doing a cash out refi, for example. So I want to share this with you guys because let me just share my screen. So this is a report from the MBA. I just made a video about this. So you probably may have seen this video already, but this is a report from the MBA just posted on November 8th for the week ended November 3rd. In that report, they share here that the refinance share of mortgage applications increased at 31.4% of total applications. So let me kind of briefly explain what this means. This means that out of all the applications nationwide for refis plus purchases, 31.4% are refis, which really caught me by surprise. So I actually reached out to Matt regarding this. But on top of that, when looking at the latest report from the Black Knight, or I should call it ICE, take a look at this. So this is Black Knight's latest report just posted a few days ago regarding the number of people who are doing cash out refis. It says cash out lending continues to dominate what's left regarding all the people who are refinancing right now. So the amount of people who are doing cash out refis represents 90% of all refis right now. So the vast majority of people who are doing a refi are taking money out of their houses. And top of that, are taking on a higher rate, which is absolutely insane. So that's why I want to bring you on today's video, Matt, to provide some information. Maybe we can kind of talk about why people would be doing a refinance and taking on a higher rate. That report covered the month of September when rates were around 7.2%, if not mistaken, according to Freddie Mac. Of course, rates today are at 7.5%, but they did peak about 3 weeks ago at 8%. So it appears that, I know I'm doing a lot of talking here, but I know there's a lot of people who are kind of scratching their head regarding why would people do a cash out refi and take on a higher rate than they have right now? Because we already know that about 80% of all homeowners have a rate of below 5% right now. So anyways, I want to kind of set the stage here regarding this. So what do you think about this, Matt?
Yeah, I mean, I appreciate the question. I think it's super valuable, and you want to bring value to the end consumer. I think you're doing people right by having this discussion, because in my eyes, the math doesn't math. 31% of mortgage applications, 31% of funded loans should not be refinances. I looked at my personal book of business, 2023 year to date. I'm 91% purchase, 9% refinance. I talked to some big brokers in California, 94% purchase, 6% refinance. While there is a few people that a refinance makes sense for, unfortunately, Jason, I think for many, they're being sold or they're being talked into a refinance. I told you a story offline, which I'll share here, which is terrifying. So if you don't listen to anything else in this video, listen to this story. A loan originator who's in my office, great loan originator, is in his doctor's office having conversation with somebody in that office who says that they're in the middle of a cash out refinance. So as somebody in mortgages, you're asking questions. And the person says, well, yeah, I've got a super low interest rate. But when I talked to the person at Quicken, they told me that I couldn't do a home equity line of credit. My only option was a cash out refinance. That's why I'm doing it. I didn't want to touch my low interest rate. And I really, poked and prodded, but they told me, no, it's not available. One, if somebody tells you it's not available, they're probably lying. As someone who writes mortgages every day, Jason, I can tell you the qualifications for a cash out refinance and home equity line of credit, debt to income ratio, and all the other things are very similar. If you qualify for cash out, you more than likely qualify for a home equity line of credit. And for those who have $400,000 locked in at 2.5% or 3% or 3.5%, and you're looking for 60,000 to pay off credit card debt, to, use for college for kids, whatever you're using it for, you're much better off leaving your first alone, doing a home equity line of credit. Unfortunately, in a time where, quite honestly, there might be some mortgage companies and mortgage originators that are desperate, the home equity line of credit pays far less commission than a cash out refinance. That's the only good reason I can think that these numbers are as inflated and pumped up as they are. And I don't want people to mishear that, debt consolidation and cash out refinance doesn't have its place. It does, but I can't imagine it does for so many people. 31.4% from MBA is a huge number. And last thing I want to say, and then I'll turn it back over to you, is we've got 10.6 trillion in tappable equity. People across the country have a ton of equity in these tougher economic times where, mayonnaise costs $7 and gas is as expensive as ever. And inflation is really hurting the average, American.
Yeah.
They're turning to this tappable equity as an answer. What you really want to be careful for is not putting a short-term fix in place, which is a cash out refinance, and hurting your financial future. Talk to a mortgage lender who has your long-term best interest in mind and talk through it. Because it might be, a home equity line of credit makes a lot more sense. For others, it might just be you only owe 80 on the first, and sure, it's at 4%, but you're taking out 150,000 for this business or this investment property. So maybe it does make sense, but you just want to make sure you're talking to someone who's given their advice through the filter of what's best for you, not what the biggest commission check for me.
Yeah, absolutely. I think you probably can add to that. You can talk to multiple people to get advice, because the advice of like, no, you're not going to be able to do a HELOC, when I'm guessing that Quicken, I don't know does Quicken even do HELOCs? I don't even know if they do or not. Regards if they do or don't, to your point, saying that a loan officer would get paid a lot more for cash out refi or just a refinance in general compared to a HELOC, then obviously there's going to be some bias in the advice that potentially someone could be giving you, which is sad but true.
Right. Yeah. I mean, I just say somebody you like and trust, because I figure you just get a hold of Matt, the mortgage guy. That's all the shopping you got to do. But maybe they'll go with your advice. They'll talk to a few people, Jason, and
yeah, this is not a paid promotion by Matt whatsoever. But yeah, you have a YouTube channel. Take a look at his channel, Matt, the mortgage guy. So maybe we can kind of talk about the difference between a refi and a HELOC, what that looks like. And I'll share just very quickly my personal experience. So my wife and I, we did a big remodel our house a year and a half ago, and I did a HELOC. The downside of that for me was that the rate adjusts each and every month as rates fluctuate. And a year and a half ago, rates were increasing. So it was stressful to try to pay it off as soon as possible before our rates were increasing. But also back in, I guess it was a year and a half ago, I was offered 0% for 6 months. So it was free money for a year, or for 6 months, basically. And then it adjusts to current rates. So right now, if you look at a HELOC, much of the intro rates they're offering right now are not 0%. They're probably like 5 or 7% right now. So that deal is basically closed because rates have increased so much. But the other side to a HELOC is that I could get a $100,000 HELOC. If I only need $50,000, I take it out. I take it out as I need it based on my remodel needs for expenses or pain. On top of that, I didn't have any fees whatsoever to do a HELOC, which is probably one of the reasons why to do a HELOC versus a cash out refi, the commission is so much higher for a refi. So I kind of want to provide those kind of cons and pros for HELOCs, but maybe you can provide some context from an underwriting perspective or any information you want to share with my viewers regarding if you have a high credit card balance, for example. Actually just announced today from the Fed, all-time record highs regarding revolving credit, which the vast majority of that is credit cards. A small increase compared to the previous month, but still all-time record highs nationwide. I think it's at nearly $1.3 trillion right now. And also the average interest rate is around 20 to 22%. It's absolutely insane. So it appears to me that we have all-time record highs for credit card balances. So people may be giving this, maybe getting bad advice and doing a cash out refi, getting rid of their 3% rate they may never see, and doing a cash out refi versus a HELOC. But maybe provide some context regarding that as well.
Yeah, for sure. And I think the best place to start is just to define the two for people that might not understand it. And so if you don't know what a home equity line of credit is, I'll just give a numbers example, and
Perfect.
hopefully
Yeah.
this helps folks. Let's say you own a house and it's worth $500,000, and your first mortgage is for $300,000. There's a couple different ways to do it. And in this scenario, cash out refinance versus home equity line of credit. A cash out refinance, you get $60,000 in cash out and you bake some fees in there. And so now your new loan amount might be $365,000, and you've got a new rate, a new payment, one mortgage at $365,000. You've got $60,000 in your bank. You pay off your credit cards or whatever you're going to do with that money. That's cash out refinance. With a home equity,
I want to hold you off there. I think what's important to note here, even though you have equity in your house and you're taking the money out, that adds to your loan balance. That's an important distinction there, because if you're taking out more money, your loan balance increases. So of course your payment's going to increase. But on top of that, if you're going from a 5% rate to a 7.5% rate, obviously your payment's going to increase greatly. So I think it's really important to let people know, if you take money out of your house, that increases your loan balance. So continue.
Right. And so in this case, increase your loan balance from 300 to 365. If you're talking about a home equity line of credit, you owe 300 on the first mortgage and you leave that alone. You continue to pay $19.42 a month or whatever your first mortgage payment is. There, you get a $60,000 home equity line of credit. It's a completely separate loan. On that $60,000, we're doing a lot of fixed rate stuff that's between 10 and 11%. So maybe it's 10.5% interest rate on just that $60,000. And then you've got a monthly payment that you pay separate on that $60,000. And while, 10.5% might scare people, if you look at 300,000 at 3% and the $60,000 portion at 10.5%, it's much better than paying the whole 360,000 at 7.5%. And so, anybody who is doing you right as a consumer is going to show you those numbers at the very least, if you're considering the two. And if there's any, type of, I don't know which one is best for me, because to your point, Jason, you go from 3, 4, 5% to 7.5%, your payment is going to increase, one, because the balance is higher, like you said, but then that higher interest rate, you might be paying an extra $1,000 a month. For most people, that's probably not the play, because now you've just, attached yourself to a brand new mortgage that's going to stretch you. Sure, you might pay off the credit cards and get some temporary relief from $1,500 in payments across these 4 different cards. But it's going to most likely not be what's best for you long-term versus 60,000 fixed rate at 10.5%, an aggressive plan to get that paid off. Don't re-rack up the credit card debt, whatever you got to do to put together a plan. But it's going to be more and more of these types of scenarios that I come across. I know, because I talk to people every day, and I know that people are struggling, and the numbers don't lie. Like you said, the 1.3 trillion in revolving debt, folks are going to try to find a way to pay that off. And when there's 10.6 trillion in tappable equity, that's the largest asset for most Americans.
Yeah,
and
right.
One of the ways they're going to use to pay off that debt.
Yeah, I think there's a couple of things we can talk about this too, because if you need money to buy a boat, maybe you shouldn't be buying a boat. If you need money to pay for any frivolous things, maybe you shouldn't be doing a cash out refi or HELOC. If you're doing for debt consolidation reasons, you have a $30,000 credit card balance that you can't pay off. It's 22% interest rate. You're being buried by the interest payments. It might make sense to do a HELOC, for example. But maybe we also can talk about we're all talking about HELOCs. We're talking about second mortgages. Maybe we can talk briefly regarding the fixed rate option versus the variable option as well.
Right. Yeah. And so, I talk to consumers, and this goes for first mortgages and HELOCs and second mortgages. Everybody's got their preference. I personally am a big fan of fixed rate debt because you know what you're going to get this month, next year. And so when you look at variable rate, first mortgage or HELOC, you have to know that this rate can and will change, and be prepared for that. Honestly, with rates where they're at now and projections for them going lower, the spread between the fixed rate and the adjustable rates is pretty minimal, where it just everybody's picking a fixed rate. Because if I give you an adjustable at 9.75 or a fixed rate at 10.5, it's close enough where the juice isn't worth the squeeze, or however that saying goes.
Yeah, it probably just goes against like what your comfort level is. For me, when I saw the interest rate increasing every month, it's like, oh man, this is like stressful. And I paid it off within a year, thankfully. But having a fixed option would kind of minimize like the anxiety regarding that. But it seems like that we're kind of like at the peak of interest rates potentially, so it's hard to know what's going to happen really.
Right. Yeah. And for people, considering doing something like this, another piece of advice I would give is have a plan, because, this is your home, and any debt you have leveraged against the place that you call home is a risk. And like any other, financial tool, it can be used to help. Like in your case, you said pay off 22% credit card debt and pay it off with a 10.5% HELOC. But I know through the hundreds of stories that I've heard through the financial crash and all that like losing a home is tragic, financially and emotionally for people. So make sure that you do it with caution. And to your point, Vegas trip and boat, not a reason for a home equity line of credit, right? And I think those days are gone for the most part. There's probably some people that still do, but use the equity in your home to make smart financial decisions. Do things that's going to help you, put you in a better position for the future. Don't do it for fun and frivolous things, because that's how you get yourself in trouble.
Exactly true. I think it's a good way to end right there. That's exactly true. So thank you so much, Matt, for joining me in today's video. And anyone who's not subscribed to your channel, I advise you guys to take a look at his channel. What are you at? You just reached 20,000 subscribers, I think, right?
Yeah, I got 22,000 or so, and I'm excited. More so that I just saw that I'm at 950 something videos. So sometime in the next 6 months, I'll be surpassing 1,000 videos. So I guess that's what happens when you record your ideas for a decade straight, is you end up with 1,000 videos on YouTube.
That's awesome. This is actually my 987th today.
Oh, I'm right behind you, man. I better start working harder.
Well, thank you, Matt, for joining me in today's video. I really appreciate it. Anyone who's watching today's video, like and subscribe. Hope you guys got some value out of this video, because it just I was just looking at these reports from the MBA each and every week, and the share of refi applications never decreased. And in fact, this week it actually increased. So I want to provide some context regarding what's really happening right now, and also some advice as well. So thank you so much, Matt, for joining us today.
Thanks, Jason.
All right. Have a great day, and we'll see you on the next video, everyone.